Okay, in this video, I'm going to go over the covered call strategy. And along with the cash protected put, the covered call and the cash protected put are the two primary kind of entry-level options transactions that you're going to want to familiarize yourself with as you get to intermediate level as an investor. So once again, we're going to use ticker JOE like we did with the cash protected put. And not as any recommendation to buy or sell. It's just a kind of a good example to teach the covered call, okay? And remember, with Seeking Alpha, you just click on Financials when you pull up the ticker, Financials, and then Options, and then you're going to see delayed quotes of the options. Calls up above and puts down below. Now, the mechanics of a covered call. So first, what you do is you are going to buy 100 shares of the stock, and in this case, we'll be paying $43.85. And then you will sell a call option, usually at a strike price at or above the current stock price. So, and again, I'm looking at the December month, but with St. Joe, we've got actually 4 months to choose from. And in a minute, we'll look at the nearer months as well. But we're going to look at December just to keep it simple. And so remember, we're going to put up $43.85, and then we're going to sell, let's say we sell the 45 strike. And so we get $3.80 for that. So that's basically the trade. Now we'll play out the scenarios. So the stock can go to zero. This is sort of one of the adverse scenarios. And so you are taking all of the risk of buying a stock. And so you're going to lose your $43.85, $4,385 in upfront capital. But you do get this little premium to kind of ease the wound a little bit, right? Now the other scenario is the stock goes to infinity. And in this case, what you've done, not to sell the idea too negatively, but you've given away all of the upside above 45 for this premium of $3.80, right? And then there's a third scenario, which is the stock just sort of sits where it is. So let's say the stock goes to 44, it goes to 42.50, something like this. So here, nothing happens. This call option will expire worthless because the stock is below the strike price. And you still get your $3.80 premium, and then of course you can reload. You can sell yet another call option. So these are kind of the different ways to think about scenarios that can happen. And a lot of times what people will do is they will sell a strike price that is further above the current stock price. So they'll give themselves more headroom. So we can look here. Let's consider, for example, the December 50 strike. And of course you don't get as much money for it, you get $220. But you actually have more points of upside, right? Instead of just one and change points of upside, you're going to get almost 6 points of upside. And then likewise, we can take it to yet another strike. Look at the 55 strike, and you get $1.25 in upside. So these are kind of different ways to think about. And if you have a scenario, of course, you're not going to know what the stock is going to do. But these kind of options, of course, in return for a lower premium, you actually get to participate somewhat more in the upside, and there's a greater chance that the stock might go up a few points, and yet the option still expires worthless, and then you can reload and maybe reload at a higher strike. So kind of a best case scenario here is you sell the 50 strike, and the stock goes from 43 and change to say 48 between now and December, which is fine. And this 50 strike expires, and now you can reload by selling, say, the 55 strike, which in the December you're going to be selling maybe that option might be dated out to June or July, say, of next year. So you might sell another call option 6 months into the future. So these are different ways to think about it. Now, also you can go short term with covered calls, just like with cash protected puts. So if we look at the July options, and you can see that, say, the 45 strike here, it's only worth 80 cents. So, and again, that makes sense, right? Shorter term options, all else equal, are going to be worth less. And then if you try to give yourself one of these call options with more headroom, so the 50 strike in July, and again, this is just 3 weeks from now, you get almost nothing for that, right? So, maybe for an option like this, it might be kind of interesting to go out, say, to September. This is 3 or 4 months into the future, and look at, say, the 50 strike, and here you get $1, right? And so you can kind of think of this as like a pseudo dividend, right? You get this dollar up front, the stock, you still could participate in the upside up to $50 a share. And, you have a solid shot of the stock staying below 50. You get $100 for your trouble, and then you can do another option later, right? So, but in all these cases, these are all contingencies, right? You're not going to know what's going to happen. And as always, with options, there's lots of ways to suffer. And the worst way to suffer is to have a stock go up a lot and you've given away that upside by selling a call option at a much lower strike. So one solution too is to, let's say you buy a few hundred shares of ticker JOE, but then maybe you only sell a call option on one of the 100 share lots or one or two of the 100 share lots, leaving you some exposure to the upside, right? So these are just different ways to sort of engineer or tweak the covered call strategy, and those are the basics, all right? So thanks as always for watching, and we'll be doing more videos on option strategies going forward. I hope these are helpful.